should your strategy be in current market scenario? We have Pankaj Pandey who's joining us this morning. A very good morning to you, Pankaj. Thank you so much for joining us in ET now. And yes, it's been a day or rather week of consolidation coming in for the markets. We saw the good rally take place in the month of April. And now we're in the month of May where you have that big quote that everyone follows, that sell in May and go away. Are you of that camp, or are you of the fact or you believe that this is the time, this May, you should just stay put where you are?
So hi, good morning. Thanks for having me. I think when you look at the month of May, yes, historically we have seen that out of 12 sessions or 12 months, 9 months have been positive to the tune of about 2%. So I really do not subscribe to that statement. But overall sense is that since we are still sort of seeing developments on the geopolitical side, it is very much possible that the market might witness some kind of a knee-jerk reaction. But in general, our sense is that after 2 or 3 months, market largely recoups most of the losses. So we are carrying a very constructive view on the markets across. And I think some of the categories, say for example, banks and oil and gas, where the bulk of the FI selling was witnessed, I think is also behind us. So I think all things are sort of falling in place for us to sort of do well going forward.
All right, but other than that, Pankaj, help us understand that where do you see the margin of safety in this sort of a market right now, given the fact that, yes, the banking and the financials was once at spot, which was garnering the most of the investor interest, but given the earnings, that theme is also not picking up well. But if not financials, then what could be where the investors could start looking at?
So I think a good part for us is that we started, or there was very low expectation of Q4 shaping up well. In the overall FY25 growth rate for EPS or overall EPS growth was expected to be about 4%. I think numbers contrary to that are slightly better, especially when I look at the commodity pack. Cement quarter on quarter numbers have been better for most of the players which have sort of come out. And I think steel relatively better, but our sense is that it is going to get better in Q1. Similarly, oil and gas, our sense is that is going to sort of get better Q1 or so. Commodity pack is definitely doing well, and this is one pack which can be looked at. I think banking has done well from a price performance perspective, and I think if we go in for a rate cut of say 50 to 100 odd bips, somewhere down the line, margin pressure is going to be visible in the first half. So banking might slightly take a backseat, but I think largely it's not really negative because FY27 things will start looking up. So most of the domestic oriented sectors are looking good. And I think what we are also sensing is that if the wallet share goes up with the tax cuts in picture, largely, you'll have some of the consumption categories like, say, hotels or hospitals or autos, and to some extent, I think even the AMCs or the real estate as a segment are picking up. But largely, it's again a stock pickers market.
Right. Okay, another important development order right now and how it actually may escalate.
So, Aisha, the way we look at it is this. So, for example, when the peak of the tariff uncertainty sort of subsided, we've seen 10% kind of a rally in market. And a lot of customers we speak to, there's a overall sense of missing out in terms of that particular rally. And our sense is that in case if we get a knee-jerk reaction because of the Indo-Pak situation, I think this will be another opportunity to sort of look at good quality stocks at good valuations. And which is why overall sense is that there is no panic in the market. In fact, we have been advising customers to sort of look at this as an opportunity because structurally, I don't think it is going to derail the overall trajectory of the markets or the overall economic growth. Economically, we are far more sound to sort of withstand any kind of a challenges coming from it.
That's the take coming in right now on which way the geopolitical tensions may act.
Has suspended its guidance for the full year because we believe that Cummins Inc. had earlier guided for a revenue growth of -2% to a +3%. What Cummins is doing is not a surprise indeed, but because we have seen all these auto companies companies and all these global companies as well taking back their guidance given the uncertainty around the tariffs and how that actually impacts their business plan. But do you believe it could hit Cummins India as well, and along with that the other players in the similar space is something that we should be watching out for?
So I'm sorry, I don't have a coverage on Cummins India, so can't really sort of give a view. But I think overall sense is that when we look at some of what we are sort of liking is more of bearing companies. I think whether it is Timken or whether it is other players, I think our sense is that these are the players where we have seen decent amount of price correction. Valuations look attractive, and post Schaeffler numbers, our sense is that things are looking a lot more constructive, not only on the auto side, but on the industrial side as well.
Pankaj, how is it that you're looking at Kotak and SBI's numbers? Of course, yesterday you did have that knee-jerk reaction and the stocks did, fall. But I was just looking at, the brokerage notes coming in on Kotak. One of them has cut the rating to a hold from its earlier buy. The price target as well has been cut there. Another cut coming in to a neutral now from the earlier buy. Again, a price target cut. And even CLSA has downgraded the stock now to a hold from its earlier, rating. Wanted to understand, how do you sense Kotak Mahindra will actually pan out, given its outperformance almost year to date, and it's managed to beat the performance stock-wise, of course, the likes of ICICI Bank and HDFC Bank also.
So Kotak, we have already seen a decent amount of price performance, but our sense is that they'll be able to maintain ROAs of about 2.2, and which means that if we are sort of giving a slight premium at about 2.4, so which is where our target price for Kotak comes at about 2,400. While yes, growth is on a slightly lower side, and same is the case with SBI. Compared to the overall growth expectation, the growth is slightly on a lower side. But then again, I think SBI is another bank where we feel that within PSUs, it can deliver ROAs of 1 or 1.1, and which is why we feel that the valuation looks relatively attractive. Yes, there could be challenges in the first 6 to 9 odd months in terms of margin pressure, given the anticipation of rate cuts. But since FIs are no longer negative on a segment like this, so we would want to be more constructive, and any kind of a price decline, I think, is a sort of a buying opportunity. So from that perspective, we are positive on both these stocks.
Right. Pankaj, I wanted to get your view on the overall earnings season, and what to your mind actually comes when you look at the way how the earnings season have panned out, because not much of these companies have actually outperformed the estimates. The fact that we also went into this quarter with very subdued expectations. Do you think now going ahead, once a picture gets a bit clearer, earnings will be the key catalyst to drive the markets going ahead?
Oh, yes. So I think you're right that we are heading, or Q4, the overall anticipation was pretty subdued. So from that perspective, earnings are not a big miss. Yes, things could have been better. But our sense is that FY26 looks a lot more better. Largely, if you look at FY25, we had single-digit kind of a market appreciation and something similar kind of earning growth. But FY26 looks a lot more better, especially from the commodity pack. I think you are seeing quarter-on-quarter improvement, and FY26 looks a lot better. And overall sense is that earnings are expected to be in low double digits, about 11-12%. So from that perspective, something similar kind of a market return is what we would expect. And so from that perspective, the earnings have not been a big disappointment. And again, I would want to highlight that as this becomes more of a stock-specific scenario. So, for example, in a case segment like auto, you have a company like M&M delivering high 18 kind of a volume growth, whereas a lot of other players are witnessing degrowth. So again, it becomes a very stock-specific market to look at.
Right, okay. Here's the word coming in from Bernstein as well. Pretty positive on DMARD's growth, but not on the margins, according to Jigna.
To encourage US drug manufacturing, though we have to wait out for the next 2 weeks to get the final clarity on pharma tariffs. But what's been your reading, Pankaj, into this? Do you believe this news flow could sentimentally impact the Indian pharma players, especially those who have a large exposure to the US market? Or do you believe that much is already in the price, given the fact that we have been lingering and that overhang has been looming for quite some time now?
So our reading of this statement is more of so far largely this order pertains to the innovator drug, as the destinations mentioned are sources of innovator drugs. So from that perspective, we don't really see too much of an impact on the markets for us because we are largely a generic sort of supplier. And on top of it, I think we are doing fairly well in terms of negotiation. So from that perspective, I really do not see a more of a knee-jerk reaction. I think this could have far more implications for Europe or other places from where the US sources bulk of their imports.
Well, yes, Pankaj, the FDA will enforce better API source reporting. That's we are getting to understand. But do you believe that some of the API players will be the key to watch out for, given the fact that the players that you are talking about, they too are heavily dependent on China for importing these raw materials?
So I don't really rule out a scenario where you see higher scrutiny from FDA, and in fact, that has actually gone up in the past few years. So yes, that is very much possible. But I think relatively, our sense is that when you talk of other competitor China, our sense is that we are relatively better placed. But yes, there is still some uncertainty around this news. So again, it's a sort of a wait and watch kind of a situation. And plus, on top of it, we are seeing some of the companies looking at having some kind of a satellite manufacturing capacity in the US. So that might also sort of mitigate to some extent the overall impact.
Right, so that's the take coming in on pharma. Rudra, on the charts, when you talk about pharma, how is that sector looking to you at this point in time? Because at the start of the year, we thought that the fortunes for pharma and IT sector would...
Asking is because just yesterday we have seen all these OMCs having a gain of anywhere between 4 to 7%. But now the cool off that we are witnessing in crude oil prices, do you believe it's only OMCs which will be the best play regarding this, or now it's the time to look at some of the other sectors which get impacted on the back of the cool off?
So I think the good part about crude is that now major players like Saudi are looking at increasing their market share. So gone are the days when they used to sort of ramp down production for maintaining the crude oil prices. Now, this is structurally very positive for us because we import nearly 10 to 12 lakh crore kind of crude oil. So any kind of a price decline is a benefit, whether it stays with the consumer or it stays with the government. Now, obviously, OMCs will benefit from this aspect. And the other aspect is that in case of there is a rewiring of the LPG supply chain, this is definitely positive for the entire OMCs, which is where we feel that things could be better. I think for a lot of other user industries, say FMCG, the benefit will start accruing from Q2 onwards. And similarly, a lot of other sectors, be it say something like cement, where our sense is that even the petcoke prices could sort of soften. So a lot of beneficiaries will emerge over a period of time. But I think crude oil prices declining and countries not really competing or not restricting price, I think is a big positive for us. And it also helps us in case if on a fiscal side, war escalates and something happens, I think we are far more fiscally better positioned to sort of undertake any kind of a financial impact as well.
So that's the take coming in on OMCs and other sectors that actually are crude fall beneficiaries. But let's talk about India and how does India actually stack up amidst the closing comments, and which is that one sector that you think in the next medium term or so will be a market outperformer and one should actually watch out for and lay their bets on, and it shouldn't be banks?
So I think I like the commodity pack, both cement and steel. I think these are the two sectors where the earnings are going to be better than the overall nifty growth. And whatever numbers have come out for, especially on the cement company side, we are liking that. And metal could be another surprise element because we haven't seen that much of a price performance, but that is another sector where our sense is that much of the benefit has not really flowed in Q4. But Q1 is where we are going to see at least the benefit of about 5,000 to 6,000 rupees increase in the prices across players. So I think these are the two pockets which relatively look good to us.
All right, so let's watch out for that. But with this, Pankaj, thank you so much for taking the time out and speaking with us. But with this, let's all.
If you like this video, then like, share and subscribe to ET Now.